Hello and welcome to this video on demand-side responses to the Great Depression. In this video, we're going to look at an interesting period of economic history, the Great Depression, which occurred during the 1930s in the UK and started really in the USA. And in particular, we're going to focus on the demand-side responses of governments during that period. So their responses in terms of fiscal policy and monetary policy and how effective those responses were. So let's start off by looking at the 1920s and the USA and the period running up to the Great Depression. Well, this has been a period of rapid economic growth in the USA, driven a lot by increases in productivity. So the division of labor and specialization, for example, the Ford production plant, boosted output and employment. Credit rules had been relaxed and there was lots of borrowing which had fueled consumption. So we had large increases in economic growth and a stock market boom. So we got possibly a kind of overheating economy in the USA in the 1920s. In the UK, not quite as pretty a picture. There's been a bit of an economic decline as the UK paid off debts that they accumulated from the First World War. And some of their primary exports, market started to face periods of excess supply, which had an impact on the prices of those exports. As a result, there was deflation, which meant it difficult to pay off the debt that they had accumulated. There was also a period characterized by the paradox of thrift, which is this concept identified by Keynes that says that during periods of recession, when it's in the best interest of the economy for people not to save but to spend, because there's a recession, people actually lose confidence and start to save. And because they save, there's even less spending, and you get a bit of a circular, a bit of a paradox going on. So this is quite a volatile period of economic growth. If you have a look at the chart on the right-hand side, we can see that from 1920 through to 1930, economic growth is fairly volatile in terms of its the percentage rate. So the Great Depression arrived in the USA in 1929. It started off by a stock market crash. So we mentioned earlier that the stock market had been booming. There was a Wall Street crash in 1929 when stock prices suddenly started dropping. This had a huge negative wealth effect and a collapse in the confidence in the economy. As a result, people were uncertain about the safety of their money within banks and started to withdraw cash from the banking system. And as a result, there were a number of bank failures. So a number of banks closed and savers lost their money, causing further collapses in confidence. So there was less bank lending, less investment, less consumption, and the economy was plunged into a huge recession. So we can see the impact here in a few charts. This first one shows us the stock market crash. So you can see the stock market index coming from a value of just under 400 in 1929, suddenly very short period of time down to 200. So kind of halving the value of all the stocks and shares, halving people's wealth invested in shares is quite significant. And you can see the continued decline during the depression that followed. In terms of economic growth, if real GDP is 1,000 in 1929, we can see there's recession and economic growth doesn't really start recovering until 1933 and doesn't recover back until 1929 levels until about 1936. So we have a long period here where the economy is way below what we would expect. As a consequence, there was high levels of unemployment. You can see the unemployment rate increasing from just below 4% in a matter of years up to nearly 25%, so 1 in 4 people without jobs. This also was characterized by a period of deflation. We can see the consumer price index for the United States falling sharply during those period between 1929 and 1933. So this was a significant recession that was prolonged and became a depression. In the UK, what was happening? Well, the UK was quite closely linked to the US economy because the US had made lots of loans to Europe and the UK to help rebuild after the First World War. As the UK economy declined, they called in those loans the UK struggled to pay them. Also, the US had introduced tariffs in 1930s to protect their own industries, which restricted global trade. And a combination of these factors, as well as the already declining economic performance in the UK, pushed the UK into recession. So again, we can see that happening here in 1929. There's a sharp decrease in economic growth. This coincides with a period of deflation as well. We can see inflation is below 0% for this period here. Again, like the USA, an increase in the unemployment rate, 7% up to 16%. And another significant feature was the high rate of national debt at this period in time. So the government's debt as a percentage of GDP was quite high, over 150% debt to GDP ratio, so quite an indebted government. So we can see another impact here with the UK, perhaps not quite as severe as the USA, but again, a recession at the start of the 1930s. Now, what drove this recession turn into depression was the policy responses from the government. So the USA's initial policy response to deal with this recession was the following. So they introduced tariffs to try and protect the industry. So tariffs are taxes on imports, and to try and protect domestic jobs, they tried to reduce the amount of imports into the USA, but this led to a trade war and world trade contracted, setting off a cycle of falling production. At this time, the US also tried to make sure they ran a balanced budget, so government spending was equal to taxation. So they thought an unbalanced budget would slow business recovery, so there was no idea here that they should increase government spending or reduce taxation in order to help the economy recover. They didn't decrease interest rates, and they didn't increase the money supply. And the latter one was not possible since in those days the dollar, their currency, was still backed by gold, which we call the gold standard. So the currency, if you exchange it, had a value that was tied to a certain amount of gold. So they couldn't just increase the amount of money. So here we have a policy response. There is no expansionary fiscal policy. We've got no expansionary monetary policy. And these were considered kind of classical economic responses at the time. In the UK, the initial policy response again was very similar, to try and balance the budget and restore confidence in the currency. To help balance the UK's government's budget, they cut unemployment benefits and public sector wages. And like the USA, they also introduced tariffs on imports, which brought about the risk of retaliation. So overall, these responses were not particularly effective, didn't provide much of a stimulus, and turned these recessions into very long periods of poor economic performance and so depressions. Eventually, there was an election in the USA, and President Roosevelt was elected, and he introduced something called the New Deal. And this was a program that launched a pretty significant fiscal stimulus, so a big boost in government spending to help try and stimulate the economy. This is 1933, so 4 years after the initial crash in the stock market. This was considered much more of a Keynesian approach. And there is some debate as to whether this was particularly effective in bringing the US into recovery. The other thing that was going on was with the start of the impending Second World War. That also required a large amount of government spending to arm the nation, and whether that actually might have been more significant. But certainly the New Deal program and the fiscal stimulus package that Roosevelt launched is something that we should know about, and is often credited with helping transform the US economy and bringing it out of the Depression. So as the Keynesian approach, we would suggest that this is what the New Deal would be doing. It would be causing an increase in government spending and shifting AD to the right, boosting the level of economic growth. They also introduced the monetary policy response. They removed the gold standard, so they said that money no longer has to be directly linked to an amount of gold, and as a result they were able to increase the money supply. Again, there is some debate over how much the increase in money supply helped the recovery, but certainly a lot of economists think it was significant. So between 1933 and 1937, the economy recovered, but it was 4 years after the recession had begun. Um, and the combination of the two, the fiscal policy response and the monetary policy response, are credited with restoring GDP growth to about 9% average. So we can see this improvement from 1933 onwards. The economy starts to grow and continues an upward trend. The unemployment rate starts to fall. Inflation starts to get back to kind of normal rates. And the stock market, although it's off the scale here, did eventually recover. So let's have a look in the UK. What was the fiscal response? Well, they did a lot of house building in London and in around the suburbs. As a result, unemployment fell, but not in all regions. Again, the policy response perhaps in the UK wasn't as significant, so still low unemployment benefits, which did create some real hardship for some members of the population. Towards the late 1930s, again, as the Second World War approached and the country spent more money on weapons and arms, that did have an impact boosting GDP. In terms of monetary policy response, again, the UK quite similar to the US. They ditched the gold standard, which reduced the value of the pound. They were able to increase the money supply and cut interest rates, and this had quite a significant effect on helping the economy to recover. Again, we can see that taking place here, an improvement in economic growth rates from 1933 onwards. Again, an improvement in the inflation rate over this period. We can see that unemployment starts to drop and government debt starts to come down as a percentage of GDP, but obviously the Second World War then pushes it back up again as the government spends more money on the war effort. So that's it. Thanks very much.